So a couple weeks ago, we got out the Consumer Price Index report and the Producer Price Index report. And some interesting trends developed out of this. So consumer prices jumped by about 0.5% in the last month, but shockingly, producer prices actually dropped by 0.9% from 1 month ago. So this was a shocking drop because this is the first drop in producer prices month over month that we've seen in the index since the pandemic started in March to April of 2020. Since then, producer prices have been elevated and have been continuously pressing up over and over again, which has been bearing higher prices on the consumer price index front. Now, does this mean that the end of price inflation is over and this is the sign that the consumer prices are probably going to calm down? We'll see. And I'll go into this video and explore, some of the various paths that could be taken from this, and then determine on whether I think that this is a one-off anomaly or if this is something that may be the beginning of a new trend of price stabilization finally. Okay. So final demand prices increased just slightly month over month. They increased by about 0.2%. And, the commodity prices of all producer prices, which measures not just final demand, but also intermediate goods and the different stages of production, that dropped by 0.9%. And yet markets were still alarmed over inflation. They did not take this as a positive sign because final demand year over year prices were still pushing up. And indeed, they pushed up to about 10% on an annualized basis. So this is the highest final demand year-over-year price inflation ever measured. Now, it's slightly down from 9.9%, which was 10% last month. And again, this is just due to this really, really slow increase in final demand. Now, what was causing the producer prices to sort of flatline and drop a little bit? Well, the big thing to do is that it happened in the final demand goods sector, and it's really in food and energy. So when we take a look at the food prices here, for consumer foods, they dropped by 0.6%. Energy prices dropped by 3.3%. So just as we saw on the consumer front, how energy prices were holding down the consumer price index monthly inflation numbers last month partially, they're also holding down that for final demand this month, okay? And that has factored into, for all commodity prices. So the feeds, the different types of commodities that go into producing food, such as grains and meats, that definitely has incurred a drop. And then there was obviously the drop of energy production, raw oil and crude. So those drops in prices definitely helped stem some of those inflation figures that we're seeing here. And it's because of those one-off situations that I do think that overall this is just an anomaly. I usually operate by a rule of thumb that once is an anomaly, twice is a coincidence, and 3 times is a trend. So if I observe for 3 consecutive months where producer prices are dropping or flatlining, that might signal that we might start seeing a drop soon to be in consumer price inflation growth numbers, okay? Now, producer prices as a percentage of the consumer price index, we can see the consumer price index in red and the producer price index in blue. I want you just to take note here, and I've produced a couple videos on this, showing that for the last 35 years or so, really the last 40 years, producer prices have been lagging behind consumer prices. So there's been a lot of cost savings of production in the producer price industry for materials and intermediate goods, which has facilitated a boom in the U.S. economy. This really started to take off in the 1980s, and more than that, it was low oil prices than anything else, which then continued in the 1990s before we started to see that run up in producer prices in the 2000s. And that was driven in large part because of excessive monetary policy. But instead of it just showing up in rampant consumer price inflation, instead it was eating away at the profit margins of businesses, relatively speaking, as they incurred higher costs for commodities and passed off some of that onto the consumer, but it's really been more, they've been passing off a third of that cost off to the consumer. But we started to see a reconvergence of the producer price index and the consumer price index in 2008. And then when 2008 happened, we had a large drop in producer prices, a small drop in consumer prices, and it's been that way up until when COVID hit, and now we're seeing sort of that reconvergence. So when we look at producer prices as a percentage of consumer prices right now, we're at about 87%. In history's times past, it has been usually running where producer prices were actually higher than consumer prices, aka the more that prices, raised on the producer front, consumer prices would follow suit, but they wouldn't follow quite as high as producers would try to employ cost-saving benefits to pass on to the consumers. Starting around the 1980s, that sort of fell away, and we started to see a large drop in producer prices, which benefited to us in the form of a boom, and also kept consumer prices in check. Now, with 2008, we started to see that melt away, and right now, with producer prices as a percentage of consumer prices, it's the highest ratio that we've seen since before the fracking phenomena that we observed in the mid-2010s that radically dropped oil prices. So the producer prices and the energy prices, hold a little bit more of a weight on here, than what they do in the consumer price index front. Another part is in the final demand services. So final demand services increased by 0.5%, and that's usually a huge weight. That's 2/3 of the weight of final demand prices. That's sort of a little bit of a difference between that and consumer prices, because consumer services doesn't really take that much of a weight on the consumer price index. And then the last part is that consumer prices have the housing index, and there's really no housing index in final demand goods per se. Okay, there is a little, you can sort of like measure it a little bit in the forms of construction and things, but that's really all that you have to really go on there. So the drops in energy prices that we saw, drops in food, kind of contained those inflation rates. But the base effect is that monetary policy, until we start seeing a change in monetary policy from what it has done historically, which historically ever since COVID hit, it's been averaging at about a 1% growth in the money supply per month. We're really not going to see that much of a calming down in producer prices or even consumer prices. Now, looking forward, looking at the final demand model right quick, the final demand model is really looking for, on average, a 0.6% increase in final demand, because that's basically been what the average and the median has been ever since we've come out of the pandemic. Unless if we start seeing radical shifts in the money supply, I don't expect that to change, although the money supply numbers should be coming out in the next few days. And I'll get some updated table numbers on that, but I don't really expect that to calm down. So with that, it's looking for the consumer prices to push up again by another 0.4%. And as I mentioned before, and I've mentioned this again, consumer prices as a percentage of final demand prices are right now at historical lows. They're bobbing around 98% of the final demand prices, whereas historically they've usually averaged at about 100%, give or take. Sometimes they've gone below, sometimes they've gone above, but they've normalized around the 100% area. And that makes a lot of sense to me on that whatever is final demand in terms of prices is passed off to the consumer price index shortly thereafter. So we should be seeing a little bit of catch up in this consumer price index report number. And indeed, if we do, then we should be seeing a little bit of an overshooting in the month of January for the consumer prices. And my guess is that we'll probably see like a 0.6% increase in consumer prices, give or take. And now, if we do see that 0.6% increase in consumer prices, that's definitely going to push up the consumer price inflation rate to 7.5% annualized year over year. And then the question becomes, is that trend going to continue, or are we going to see a sort of calming down and stemming down? Based off the 1 month final demand numbers, this seems to be a kind of a positive indicator for commodity prices and final demand that consumer prices may be starting to calm down inflation-wise. And, to add to that, let's take a look at the dollar index and just see what's going on with demand for U.S. dollars. So demand for U.S. dollars is still holding up, relatively speaking. And this has been rallying as the rest of the world has been gripping with geopolitical issues as well as COVID pandemic shutdowns. So that's really been causing a mad scramble for U.S. dollar and U.S. dollar denominated assets. And up until early January, that has paid off in gains and returns financially for those investors. Now, with the reversal of those returns based off of higher inflation and looming higher interest rates as the Fed tries to raise interest rates to contain inflation, we'll see if the dollar is able to stay shored up as people, basically hold more cash, or whether they dump financial assets for some other better alternative. In this case, my speculation is that some of that money should go into precious metals and cause sort of a mini rally at the very least in gold and silver, if not a full-blown bull market. But right now, that dollar index seems to be holding up, and as long as it does, that seems to reinforce the narrative that what we're going to be seeing transpire, hopefully, is for consumer prices to remain at a high confidence in the U.S. dollar, and with that, it will help contain some of that price inflation. But there's definitely still a risk that it could divulge and it deteriorate and grow and for consumer price inflation to build. So one of two things is going to transpire, and I'm going to go over another video on this because I'm going to analyze the trends of the confidence in dollar currency in the wake of the 70s and the 80s and the 90s and then the 2000s, 2010s, and compare that to now. But one of two trends is going to develop here. And either A, we're going to see consumer prices constantly build to 9% inflation, and we'll still see some rising commodity prices and final demand. And what that would mean is that what happened this month is that we saw a temporary lull in commodity prices on the producer price index front, but it was just a drop from a really, really high peak. And it's not enough to really contain the consumer price inflation rates. And then, of course, the producer prices are just going to build anyway. Certainly, rising oil prices and worries that oil could get back over $100 a barrel feed into that narrative. Or what we're going to see is a calming down in final demand, and that would result in a calming down in consumer prices in the coming months. Now, monetary policy and the credit binge that has been going on with debt going into the economy, as well as the government binge, runs against that narrative. But there's definitely a possibility based off of an appetite for U.S. dollars abroad by foreign investors that sort of feeds into and may actually provide some stemming shoring up of the U.S. currency and therefore U.S. prices, as we are effectively able to export some of that inflation. Another thing that has helped out, I think, in the U.S. dollar is that on an annualized basis, government total expenditures have dropped since they peaked in Q1 of 2021. So early on in 2021, with the onset of the new presidential administration in the U.S. government, there were stimulus bills that were passed to try to increase and spur growth in the U.S. economy through driving up consumption and that consumption component of GDP. And so government spending on an annualized basis actually increased to almost $11 trillion. That has since dropped to $9 trillion, and though that's nowhere near to the pre-COVID levels of $7.5 trillion, it's definitely the lowest that has been transpiring in 2021. We do not have the Q4 2021 figures, but we're probably going to see those drop off a little bit more. But what that means is that the driving up of the consumption of resources by the U.S. government for consumer goods, facilitating out and paying more people to spend money, that relative drop may have caused some of this calming down in the producer price front, because now resources are relatively more available than they were before. That sort of, feeds into that narrative that, we might see a little bit of a calming down in the U.S. inflation front, combined with a more tightening, relatively tighter monetary policy. So there's definitely a split there that's been going on, and I'm going to do a little bit more of a deeper dive as to what's transpiring here, but definitely a pleasant surprise that we saw some, relative calming downs, at least for 1 month, on the final demand and commodity prices. Again, I personally think that this is just an anomaly. If I see it for 3 consecutive months, then what I will make a prediction on is that we should be seeing some calming down in the consumer prices. So one of the things that's been interesting and has been part of times past is that when we take a look at the CPI and compare it to the producer price index, historically speaking, the CPI has usually, and this has been the case for the last 3 peaks of inflation, the CPI inflation rate has usually hovered around about 35% of the producer price index, or roughly 1/3, okay? So, when we take a look at what has been going on with producer prices, in this realm, consumer prices are now about 33% of producer prices, okay? So because of that, and what we've been seeing with the CPI year over year, what that means is that more than likely what we've been noticing here is that the inflation rates for the consumer price index relative to producer prices is more holding in line with what we've noticed in previous peaks. It's still a little bit on the low side. Again, I adjusted these numbers right quick to get that better figure here. Let me put this out. There we go. It's about at that 35% level. And because we're seeing it at that 35% level, if the relationship holds true, then what we should be seeing is that the consumer price inflation numbers have basically caught up to the producer price numbers. Producer prices are usually lead the consumer prices in the inflation peak, but now that we've seen them catch up per se, and catch up to that historical realm of about 33 or 35%, as has been noted in previous peaks for the last 15 to 20 years, then really what's to say is that if we do see an abatement or flattening out of producer prices, then that should transpire into a flattening out or an abatement of consumer price inflation rates. And that would feed into narrative 1, that we're seeing a calming down in the inflation rates. If consumer prices do come down to about 4.2% annualized, that would be a producer price inflation rate of about, say, 12%, give or take. So that's my take on it, guys. Definitely too early to tell whether this is going to be a trend or not. Certainly the markets seem to have overlooked this. They're still really worried about price inflation, and rightfully so, because at the very minimum right now, government spending is still really, really high compared to historical trends, especially as a percentage of GDP. Monetary policy is still increasing the money supply at more than double-digit rates, and we're having debt increases at double-digit rates, and that's going to come out in the form of higher prices, combined with pandemic issues and shortages, as well as issues going on at the ports that are, having some supply constraints, and then the restrictions that have been imposed on COVID that is preventing the free flow of resources and labor to help utilize those resources properly to maximize efficiently the production process of the economy, certainly are headwinds and can contribute to higher inflation in the couple months. So we're going to keep an eye on this. This is something to very much take note, because this will affect financial markets, especially if we see falling inflation rates, and so that could be a bullish sign for financial markets. But again, with 4.2% consumer price inflation, that's still going to cause rising interest rates on the 30-year and the 10-year government treasury, which will feed into higher corporate bond rates, and that's going to have negative effects on the financial markets and eventually the U.S. economy. I'll produce a video on that in the coming days on giving my own take on what's been going on in the financial markets. I've definitely been keeping an eye on the situation and been very appraised about the recent trends. So later on this week, I'll definitely give you my take on this and where I think things are heading in that department. Guys, once again, I thank you for watching this video. If you like my content, if you like the information that I am providing you using this own data analysis and economic tools, then just make sure you give me a little like. That shows me a lot of support on my own video content. You're always welcome to share my videos on any kind of social media as you deem fit that you want to with other people that may be interested in this to get the word out. And always subscribe to my channel if you haven't already, so that way you can follow me. And click that notification bell. When you click that notification bell, you'll always be notified as soon as I do upload a new video to YouTube. And you'll be able to get access to my new content that I provide to you as early as possible. Once again, guys, I thank you for watching this video. I'll probably produce another couple more, at least later on this week. And I'll talk to you next time.